Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Wednesday, March 29th, 2023. And our top story today, the SEC's swing pricing proposals impact on investors. And joining me now to discuss this and a lot more, Tim Rouse of the Spark Institute and Shelly Antonewicz of the Investment Company Institute. Shelly, Tim, great to see you. Thanks so much for joining us on the program this morning.
Good to be here.
Thanks for having me.
Yeah, Tim, always a pleasure seeing you. Shelly, it's nice to meet you. Shelly, let's start off with kind of a baseline here. And this is kind of news to me, and it might be news to some members of our audience. What's the SEC's swing price proposal, and how does this proposal differ to the way pricing is done today in the mutual fund industry?
The swing pricing aspect of the SEC's proposal would fundamentally change how mutual funds are priced. Today, a mutual fund's price is at its net asset value, NAV, which represents the market value of all its assets, less its liabilities. The SEC proposal, however, would force all mutual funds. So think about stock, bond, and even target date mutual funds to adjust their NAV by a swing factor. How a fund's NAV would swing on any day depends upon which direction the fund's net flows went on that day. If a fund has net redemptions, even if it was only just a single dollar, it would always adjust its NAV down by this swing factor. When a fund had net inflows that exceeded 2% of its assets, it would adjust its NAV up by the swing factor. But today's funds don't have complete information on their daily flows by the time they start the pricing process to know whether they should swing the NAV or in which direction. So the SEC included a 4 p.m. hard close in the proposal.
So Shelly, why does the SEC believe that this proposal is important and should be considered and put forth, and how does this impact the retail investor?
Well, the SEC claims that swing pricing will address something called dilution. And this is the idea that redeeming shareholders impose costs on those remaining in the fund, since the fund may have to sell assets to cash out the redemptions. But, if you know a mutual fund, this is the nature of a collective investment pool. Everyone enters and exits at some point. Furthermore, the actual amount of dilution, which ICI estimated, is on average just a few basis points per year. Far too small to incentivize investors to redeem. And also, I think more importantly, it's barely a blip when you compare it to the long-term returns that investors have enjoyed in their mutual funds.
Well, Shelly, thanks for the baseline. Obviously very important. Now, why does the SEC think that this proposal is necessary? And ultimately, what's the impact to the retail investor?
Well, the SEC claims that swing pricing will address dilution. And this is the idea that redeeming shareholders impose costs on those that remain in the fund, since the fund may have to sell assets to cash out the redemptions. But if you know mutual funds, this is the nature of a collective investment pool. Everyone enters and exits at some point. Furthermore, the actual amount of dilution, which ICI estimated, is on average just a few basis points per year. It's far too small to incentivize redemptions, and it's barely a blip in comparison to the long-term returns that investors in mutual funds have received. The proposal swing pricing and hard close aspects would be really costly, extremely costly to implement, and incredibly disruptive to shareholders. ICI is very concerned that the more than 100 million American investors who use mutual funds to meet their financial goals such as saving for retirement, a down payment on a home, or their children's education, will be adversely impacted by this proposal. These people are mostly everyday middle-class families who value the professional management and diversified exposure to stock and bond market returns that mutual funds afford them.
Well, Tim, thanks for that, Shelley. And Tim, thanks so much for joining us on the program. It's always a pleasure to chat with you. Shelley laid out, I think, a really great baseline about the SEC proposal and the case for or against for retail investors. What about retirement savers? That's a group that you and Spark advocate for.
Sure. So Shelley mentioned the hard close, and a large majority of participants investing in their 401ks for retirement invest through intermediary platforms. And it essentially, with the hard close, essentially it turns 130 million American savers into second-class investors and favors institutional Wall Street investors over Main Street investors. Second, it makes everyday retirement plan transactions such as purchases, loans, required minimum distributions extremely difficult, if not impossible, to execute. It will undermine the open investment architecture system developed over the last 30, 40 years, potentially leaving retirement investors with fewer choices in their retirement program. And finally, ultimately what it does, Jeff, is it erodes retirement savers' confidence in the system, since transparent, timely pricing will not be widely available.
Well, thanks for that, Tim. And Shelley, just to pivot back to you, it sounds like that there's some level of agreement between industry professionals, consumer groups, that implementing this pricing change could have very difficult or bad effects on investors, whether they're retirement saving investors or retail investors. Your perspective on that?
Well, absolutely. There is so much agreement that this proposal is just a bad idea. Based on the comment letters that have been filed with the SEC, it's clear that opposition to mandatory swing pricing and the hard close is nearly universal. Commenters are clear that the supposed solution is extreme, overbroad, and costly, and would more than outweigh any of the supposed benefits. Groups, that are opposing this part of the proposal include, among many others, ICI, Spark, Chamber of Commerce, Consumer Federation of America, and Better Markets. Also, opposition from Congress has been bipartisan, with Representatives Ann Wagner and Brad Sherman also writing to Chair Gensler, expressing their concerns about how this proposal would affect millions of American working families.
Tim, coming back to you, it sounds like there have been a lot of comments, many of them in the negative. How is Spark advocating, along with ICI and the other groups that Shelley mentioned, against this proposal, and what can we expect what can members do, and what can consumers do?
Well, as Shelley mentioned, there's been a lot of organizations that have submitted letters. Spark has taken this issue to Capitol Hill, and as Shelley points out, got a warm reception from both sides of the aisle and Capitol Hill, which is, again, a testament to how detrimental this will be. Because again, ultimately what it does is it's bad for the individual investor, and therefore it erodes their confidence in the retirement system. So we're keeping the focus up here with episodes like this to get the message out. But across the board, there has been widespread disagreement with this proposal.
Yeah, well, it's coming at a great time, especially when retirement investors and others are really struggling to put as much money as they can away for their future. Tim, Shelley, always a pleasure chatting with you. I need to take a very quick break. When we come back, we'll get more perspectives on the SEC's swing price proposal You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Tax audits, tax liens, wage garnishments.
Every day we hear stories like this about good folks who are simply struggling to pay their bills. Each of them are living a frightening IRS tax nightmare, and they are afraid it will destroy their lives.
I'm a divorced single mom, and my ex-husband left me and the kids with a lot of unpaid bills, including unpaid taxes. I was really starting to show my stress on my kids because the IRS had sent me a letter demanding a huge payment from me. I couldn't afford it. So then the IRS was threatening to garnish my wages. I'm already living paycheck to paycheck. That would have put me over the edge financially.
It truly seemed hopeless, but then a friend at work told her to call the tax relief line.
The people at the tax relief line, they told me about something called innocent spouse relief. They worked it out so that all of the taxes from my ex are not my problem. I don't know how that works, and I don't care. All I care about is that I don't owe the IRS a dime, and they are not going to take my paycheck.
Even if it seems hopeless, you should call the number on your screen right now. There is absolutely no cost for the call or the consultation. You are under no obligation. If you are worried that the IRS could garnish your wages, seize your assets, even take your home, call us right now. The Tax Relief Line is here to help you. Now you have a knowledgeable, professional team of tax experts that are ready to negotiate with the IRS and fight for you to save you money. The Tax Relief Line's professionals have successfully negotiated thousands of cases, reducing and sometimes even eliminating the tax debt for their clients. It's very easy to get started. Simply call the number on your screen right now. You don't have to live in fear anymore. The call and the consultation are free.
Well, Shelley, thanks so much for staying with us. And Michael, welcome back to the program this morning.
Hey, thanks for having me back.
Michael, let's start with you because in its rationale, the SEC points out that the European markets are already doing the swing pricing and they're trying to compare that to the U.S. market. And hey, it's no big deal. But is that really a fair and rational comparison to compare the Europe mutual fund and the U.S. mutual fund markets?
Well, thanks for having me back. And you know I'm going to say absolutely not.
Yeah.
There are a number of differences between the European market and the U.S. market that really don't make sense as an analogy. First of all, in Europe, swing pricing, which Shelley talked about in the prior segment, is totally voluntary. There are many European funds that have adopted it, but they do so on a voluntary basis when they have the kind of information on a daily basis that makes it possible. Secondly, it really is not appropriate to compare the U.S. market and the European market in terms of not just the size, but the complexity of the types of products that are available here. Third, as Tim talked about, the U.S. market has this incredibly sophisticated and developed defined contribution system, which allows for incredibly sophisticated 401k plans and other plans like 403bs and 457s. And that just does not exist, not at the size or complexity in the European market. So I think it's fair to say that while it might work very well on a voluntary basis in Europe, here in the US, if you impose it mandatorily, including that hard close, you are essentially going to break the 401k record keeping system.
Well, thanks, Michael. Shelley, I want to come back to you because in talking about this change, one of the things that we often talk about on our network, and I think that you at the ICI and other groups like Spark think about, is the education or the communication component. This would be significant because so many investors, retail investors and retirement investors and 529 investors would have to basically relearn and re-understand how trading is done. That's significant here.
It certainly is. You know, planning and investing for the long term, especially retirement, is hard enough. Now, under the SEC proposal, mutual fund investors are going to also have to consider timing of any kind of orders they want to put in. So if you just wanted to go in and rebalance your 401k account, you're going to have to consider timing. And, and this is because of this 4 p.m. hard close. Because of the 4 p.m. Eastern hard close, all of the machinery that gets your order, when you submit your order to the fund, has to be backed up. It has to be backed up earlier in the day so that orders will get cut off. So think about it. It could be 10 a.m. with for certain record keepers. So if you don't have your order in by 10 a.m. Eastern, which would be 7 a.m. on the West Coast, if you don't get your order in, or if it didn't get to your broker you got your order in to your broker or retirement plan, but that didn't make it to the fund by the cutoff time, you wouldn't get today's price. You're going to get tomorrow's price. And that means retail and retirement savers, they're going to take on more investment risk. Today, they can see what's happening in the market and they can decide to trade. Under the proposal, they're going to be trading blind.
And that just adds to the already complex conversations that we're having, Shelley, with longevity, retirement income, putting away enough money, accumulation. There are so many complexities already out there. It just adds to the complexity here. Mike, I want to shift back to you because we've talked a lot about retail investors and retirement savers, all very important constituencies. What about some other plan types that might be impacted here?
Any time that you invest through what we call an intermediary, you are going to be impacted because, as Shelley said, the proposal would essentially require that intermediary to have to get the trade to the mutual fund by its cutoff time and not be able to do any processing after 4 p.m. So, for example, if you are in a 529 plan, saving for college, that's an intermediary. Most of the time when you save through one of your states, you're not buying a mutual fund directly. You're often buying an interest in a trust that itself invests in a mutual fund. And 529 plans can present some unique challenges if the SEC proposal moves forward. For example, in a 529 plan, the tax law only allows you to rebalance your account twice a year. And so once you introduce all this complexity, making it very difficult to process a rebalancing, which we can now do overnight very easily, that's going to provide some significant problems, as well as delay things like getting your money invested and getting money out of the 529 plan to pay for college and room and board and to get your college kids food. But there are others as well. Another example is variable annuities, which is a situation where you buy into an annuity, which then invests in a mutual fund. And that is an intermediary. The experience of holding a variable annuity, the process of getting your net value, all is going to what we call break under the SEC's proposal, because as Shelley laid out, the pricing is no longer set in the way that it has been for many, many years.
And Michael, last question before we have to wrap up the show. I mean, Shelley and Tim in the first segment really talked about kind of the industry and the consumer groups that are maybe against this proposal and what it could mean, because it has some negative and let me do this again. All right, sorry. 3, 2, George W. Bush of retirement. Here we go. 3, 2, 1. Well, Michael, Shelley and Tim both talked about some of the opposition to this change, and you've talked about it as well. And also people in Congress seem to be listening. What's your perspective on that, and what can we expect in terms of proposals against the SEC's proposal?
Well, the first point I'd make is that this is not new. The SEC proposed a hard close about 20 years ago, and the opposition from Congress back then was the same as what you're going to see now. 20 years ago, in fact, there was a letter from a couple of young House members by the name of Rob Portman and Ben Cardin, who now you all know moved on to the Senate and are one of the architects of recent retirement legislation, including Secure 2.0. They wrote to the SEC 20 years ago to say, hey, this is going to harm retirement savers. And the SEC dropped it 20 years ago. As Shelley mentioned in the prior segment, we're already seeing opposition, bipartisan opposition from Congress, with a strong letter from members Wagner and Brad Sherman, who are the chair and ranking members of the subcommittee on capital markets in financial services. And as Tim said, we've already reached out to many folks on the Hill. And the reaction has largely been, well, first explain this to me, it's very complicated. But then once they kind of get how harmful it's going to be, we're seeing a lot of concern from a lot of members of Congress. So I think you will see, not only will you see that letter from members Sherman and Wagner, but I think you're going to see other members of Congress express significant concern, particularly the impact on the millions of Americans saving for retirement.
Yeah, well, this is really important. I hope audience members have digested this. Shelley, Mike, it's great to talk to you as always. Thanks so much for joining us. Thanks for advocating on behalf of retail and retirement savers. And we look forward to having you both back on the program again very soon. And that wraps up this episode of BRN AM. Have a topic of interest, somebody you think we should talk to, then drop us a line. And don't forget, for all the latest curated news on lifestyle, wellness, finance, tech, so much more, all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content? Well, visit our website and, of course, all of our streaming partners. We're back again tomorrow for another great edition of BRN AM. Until then, I'm Jeff Snyder. Stay safe. Keep on saving. Don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the first lifestyle and wellness network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.